In this week's video, we'll demonstrate why there's an important message in a small group of not so widely followed charts. We'll be moving quickly, so feel free to use the pause button on your video player. In the markets and in the trading community, there's a tendency to focus on individual stocks and individual ETFs, which can obviously be beneficial. From a bigger picture perspective, it can also be helpful to weigh to the evidence, including using multiple time frames and multiple reference points. To quickly set the stage for the charts that follow, chart on the left side of your screen, May 10th, 3 p.m. Eastern Time, NASDAQ 100 weekly, up approximately 1.5% for the week, S&P 500 approximately 1.8%, tech hovering around 1.4%. All three of these charts, NDX, SPX, XLK, prices above an upward sloping 30-week in blue, upward sloping 40-week in red, and an upward sloping 50-week in green. This is being recorded around 3 p.m. on Friday when the S&P 500 was up 8 points. Daily chart of the Dow Jones Industrial Average price came up late 2021, early 2022 here and failed at the blue line. Really weren't even able to get back to the blue line late in 2022 here, nor in the second half of 2023 here. That changed in Q4 when we exceeded the blue line with a bullish breakout. So far, this pullback looks like a retest of this breakout, with all of this consolidation occurring above an upward sloping black 225-day moving average. Very, very similar to price action over here occurring above an upward sloping black 225-day moving average. Longer a market goes sideways, the bigger the move we can expect to get when we either get a bullish breakout or bearish breakdown. Right now, this is in bullish breakout territory. Very similar situation. Broad Dow Jones Composite average just now trying to break out and exceed the 2022 high and hold above that 2022 high. Again, all of this price action up here occurring above an upward sloping 250-day moving average in gray here. Similar broadening out and still leaning bullish theme. NYSE Composite early in 2022. Stop me if you've heard this one before. Unable to get back to the blue box, top of the blue box here late in 2022. Couldn't do it here in 2023, nor here in 2023. That changed early in 2024. So far, this looks like a bullish breakout and a retest of these levels back here. Longer above, the more meaningful it becomes. These areas in here, volume by price, these bars, what once acted as potential resistance in here, may now act as support if price comes back into the blue box. Again, similar theme here. Midcap 400 index weekly peaked late in 2021 here. Was unable to get back to that line in 2022, nor in 2023. That changed in 2024. We had a bullish breakout. This looks like a retest. And now we're trying to reclaim this black line here tied to the pre-bear market high. All of this price action occurring above an upward sloping 30-week moving average in blue, 40-week moving average in red, and 50-week moving average in green. Price above upward sloping moving averages during the bear market, price below downward sloping moving averages. Blue, the fastest moving average, is on the bottom here in 2022. Today, blue, the fastest moving average, is on top. Using a weight of the evidence approach, very similar themes. RSP, the equal weight S&P 500 in isolation, entered the black box here way back in 2021. Came back to the same area here, September, October 2022. Failed at the top of the box before the bear market here late in 2021, early 2022. Haven't been able to get above the black box until calendar year 2024. Longer above, the more relevant it becomes. As we mentioned a few weeks ago, these are not particularly scary charts from a risk-reward perspective. The longer a market goes sideways, 2021, 2022, 2023, and into 2024, the bigger the move that you can expect to get. Concerns would increase on all of these charts if price popped down into this area here. That may happen very, very soon. Hasn't happened yet. Also noteworthy, look how tight the moving average cluster is in here in February and March of 2022. February price drops below the moving average cluster. The moving average cluster starts to roll over. Look how tight it is in here. And then in the second half of 2022, really walking forward from May 1st, for the most part, price is below the moving average cluster. Contrast that with what we have on the right side of the screen in 2024. Price is above the moving average cluster. Slope of the 225-day moving average in black here, down during the bear market in 2022. Polar opposite in 2024. The black line is upward sloping. This is what an uptrend looks like. This is what the transition from an uptrend to a downtrend looks like, and this is what a downtrend looks like. We've covered monthly cloud charts like this in the past. They've been very, very helpful. We're going to focus on one aspect of this chart. Down here, after the bear market in 2002, blue crosses above red here, signaling a flip, part of the process from a flip from a downtrend to an uptrend. XLK rose for several more years, with the emphasis on the word years. Similar situation after the financial crisis bear market late in 2009. Early in 2010, blue pops back above red, signaling a strengthening of the long-term trend. And XLK rallies for years. Come up here. Blue drops below red here in 2022 during the bear market, recaptures it in July of 2023. Thus, blue crossed above red less than a year ago. Full bore bullish look, checking all of the bullish boxes on the long-term monthly cloud chart. Green above price, blue above red, price above red. Price above the cloud is green. Still looks like a long-term uptrend. Also covered this chart in the past, and it has also been helpful in recent months. Similar situation, monthly NASDAQ 100, $sign NDX, blue above red here. Notice the bearish cross here in January of 2001. The stock market doesn't bottom until October of 2002. We get the blue back over red here late in 2003, early in 2004. We get the bearish cross here in September of 2008 during the financial crisis. Stock market doesn't bottom for several more months. In March of 2009, we get the bull cross here in 2009. After this cross and after this cross, the market rallied for several more years. Kissing look down here, similar in the 1990s. After blue separated from red, the NASDAQ 100 rallied for several more years. The longer we hold this look, the more relevant it becomes. In last week's video, we used these daily charts dated May 3rd. This is SPY, RSP, SCHG, XLK, IWM, and the NYSE composite in the lower right-hand corner. Everything that we said about these charts last week still applies, since during Thursday's session, SPY was up 1.69% for the week, meaning this chart, if anything, has improved. RSP up 1.76%, growth up 1.57%, XLK up 1.15%, small caps IWM up 1.72%. Very similar look for the NYSE composite. This also is starting to look like on the NASDAQ weekly chart. A breakout here above these levels in late 2021, left side of your screen. We broke out here. This looks like a retest. And now we're trying to recapture that level on the weekly chart. Notice in the bear market, price is below the 30-week, the 40-week, and the 50-week for the most part during the entire calendar year until the S&P 500 bottoms here in October. The NASDAQ doesn't bottom until late December of 2022, and then the trend flips. Since then, for the most part, doesn't really look anything like this. Blue on the bottom, blue on the top, slopes up, price above. So far, this looks like corrective activity within a long-term bullish uptrend. This is early 2022 here. You can see the NASDAQ peaks bottom panel here. This is 1 to 3 month Treasury bills, BIL, relative to the S&P 500 tech sector, XLK. This is the fear of inflation or increasing fear of inflation look. Increasing fears about interest rates and Fed policy. You can add in valuations. And you can see in the lower panel here, the NASDAQ in 2022 does not perform well with that look. If we drop in 2023 and 2024, it's fair to say that the present day trend here really doesn't look anything like the concerning trend in 2022. Now we're looking at the same ratio, BIL divided by XLK. This is an anchored volume weighted average price chart. Upper left-hand corner of your screen, calendar year 2020. This is that bear market increasing inflation fear look in here. And you can see the ratio, the look starts to change relative to the anchored volume weighted average price lines. For the most part, price stays above these lines here. That shifts early in 2023 here and back to more of a bullish look. This is your bullish look over here after the major low in 2020. This is an important cluster region in here near the letter C. This is an important high here near the letter B and an important low here near letter A. You can see right now, if we tie anchored volume weighted average price lines to C, to B, and to A, the ratio is below all of those colored lines. Very, very similar to look during the correction in 2023 here between point A and point B. Concerns about inflation, interest rates, and Fed policy and valuations would increase if the ratio can start to move in this direction. Potential resistance in this band here, currently we're below it. Potential resistance here and potential resistance here. This is tied to the very long-term trend. You can see the ratio eventually reversed near the blue and orange lines. The charts that we've covered thus far speak to bull-bear probabilities, looking at trends in isolation, and concerns about inflation. When we look at a ratio like this, small caps IWM divided by XLK, the tech sector ETF, we're talking about weightings and leadership. Really haven't seen anything here that says the long-term trend has flipped in favor of small caps at this point. Probabilities for small caps relative to tech would improve if the ratio can get out into this white space, and they would improve even further if the 200-day here, 225-day here, and 250-day in black could start to flatten out and then turn up. Everything that we just said about the previous chart also applies to this chart. RSP, the equal weight S&P 500 relative to XLK. It is noteworthy. Here in 2023, look how far away the ratio is from that downward sloping 250-day moving average. We're much, much closer today, telling us the probability of a trend reversal is higher today than it really was at any time back in here. Still hasn't happened yet, but it tells us to keep an open mind potentially about the ratio getting out here, which would also move it closer to the 250-day potentially flattening out and then turning up. Some improvement here for RSP, but nothing major yet. Another subtle shift on this chart. This is a weekly chart now. We've got the 200-week moving average in red, and you can see it is decidedly sloping downward. The subtle change is back here in 2023, you can see the ratio of RSP to XLK on the weekly chart is nowhere near blue, green, and pink. Again, not the case today. We've had a couple of weekly closes above blue, the 30-week moving average, telling us to keep an open mind about this ratio morphing into a counter trend look similar to what we had here in 2020 and 2021. Still has a lot of work to do, but has shown some improvement. Right now, slope is down, fastest moving average is on the bottom, slope is down, slope is down, slope is down. There's a complex chart here, but it's easy to understand. This is RSPT, the equal weight tech sector. relative to RSP, the equal weight S&P 500. So equal weight tech relative to an equal weighted version of all the sectors in the S&P 500 index. You can see during the bear market, tech underperformed here. This is early 2022 here. You can see we dropped below the anchored volume weighted average price lines, and the slopes decidedly take on a negative look. Down here, when the NASDAQ and tech bottomed late in 2022, the ratio held near this line, and this line, and these denote the long-term uptrend favoring the equal weight tech sector over RSP. So right now, the ratio is above the anchored volume weighted average price line tied to this 2022 high. It's above this low here where the current rally started. That's that pink line here. And it's even above this clustering look in here where orange and purple intersect, but testing that line now. If this ratio can stay above this orange line here, it's hard to make an argument that this uptrend is in serious jeopardy. If you get into this area here, the longer you stay there, at least from a shorter term or intermediate term trend perspective, the more concerning it would become. But right now, the relative trend for tech versus this low here is still intact. More vulnerable? Yes. Very similar situation, XLK divided by SCHB, the U.S. Broad Market ETF from Schwab. This is where the rally started here late in 2022, early in 2023. You can see we got extended from these upward sloping anchored volume weighted average price lines. We held here at the red line. We held near the red line here, and we're back to that same line. The purple lines tied to this low here and this low here late in 2022, early 2023. Also noteworthy from a price perspective, the ratio up here is still holding above this high here in late 2021 and this high here in 2020. So if we drew a horizontal line in this region here, this is your bullish breakout. For now, it's still holding. Let's cover XLK relative to XLF. That's the large chart on your screen, and XLK relative to XLU at the same time. Similar situation. The ratio is coming back. It's still above these anchored volume weighted average price lines here, but you can see they're starting to flatten out. So these are based on the technology sector relative to the financial sector of the S&P 500. The longer-term uptrend in the ratio is down here. So if the ratio gets into this white space here, you could expect XLF to continue to outperform XLK in the intermediate term. If we were going to say that in the long term, that ratio would need to drop below these lines here, and the longer it stayed below, the more relevant it would become. Similar situation here, XLK relative to XLU. This is the peak here. This is the bear market. This is the low. You can see all of those anchored volume weighted average price lines intersect in this area here. The ratio got very extended in favor of XLK, and recently utilities have been outperforming XLK significantly. Right now, all of that is happening above these upward sloping lines and also above this high here in late 2021. Very similar to the conversation over here on the right side of the screen. Probably more outperformance by XLU if the ratio gets into this area here. And the longer term trend would be more in jeopardy down below these lines and down below this line here. Right now, this still looks like a bullish breakout, somewhat of a retest, and this rally from down here in late 2022 for now is still intact. If you want to see where these lines come from here, you can see these lines here are tied to where the rally began in favor of XLK over XLF. This is early 2023. Right now we're testing that line and it is flattening out. But the ratio is above the anchored volume weighted average price line tied to this high in 2020, above the line tied to this low in 2021, and above the line tied to this high in 2022. You can see all of those lines intersect in this region here, and this is the big bull push higher early in 2023. Now we're looking at a standard daily chart, 20-day, all the way out to the black 250-day. It's a little odd for utilities to outperform tech like this, so we should keep an open mind about what it potentially means. However, this is the fearful look here where the bear market starts early in 2022. Look how tightly clustered the moving averages and price are here. That's not what we have over here at this point. In fact, these lines are spread out significantly more than they were even in here. So this is a strong downtrend against XLU and in favor of XLK. Right now, this looks like a strong counter trend move. The more the look down here morphs into something like this over here, the more concerning it would become. We'll keep an eye on it. XLK relative to the broad S&P 1500 composite in the ETF world is XLK relative to SPTM. Rally down here 2019. That's where we bottom here in 2023. You can see the ratio is still above the anchored volume weighted average price line, the orange line tied to that major low. This is where we are this week. There's a cluster of lines right in here tied to this area here. More importantly, this high here, this low here, and this high here. We draw a line right in this area here where those lines acted as resistance. Price held at the light blue line here, here, trying to hold here. Very, very similar situation. The outperformance in the short to intermediate term of SPTM would most likely continue if the ratio moves into this area here. This is the longer term look here, these lines. And this is the very long-term trend down here, the red line favoring tech over SPTM. Bottom line, there's nothing that we have in hand yet that says there's some type of major leadership reversal relative to this low here in 2022, 2023, and relative to the current rally. That may change very, very soon. It just hasn't happened yet. When we look at a chart like this, probably fair to say the odds of underperformance continuing for XLK relative to other S&P 500 sectors probably a little bit higher today relative to any point back here. So we have to be open to this ratio dropping below these two lines here, but thus far it's holding. So back to SPY divided by XLK. This is the traditional daily chart, 20-day in blue all the way out to the 250-day in black. Ratio above for the first time in quite some time. Blue, the 20-day moving average, popping above the black 250-day for the first time in quite some time. Again, telling us to keep an open mind about tech potentially continuing to underperform for a time. Having said all of that, if we look at the same ratio using anchored volume weighted average price lines, really haven't seen anything yet too alarming. This is where the underperformance for SPY or the outperformance for XLK began early in 2023. That's the purple line. You can see the ratio is still below that line. Similar situation in here. This is an important area when you get clustering. Came up and acted as resistance, the cluster of all the lines. If we tie anchored volume weighted average price lines into that cluster, ratio was rejected here, and thus far remains below those lines. We'll learn something about the continued outperformance of SPY relative to XLK if the ratio gets out into this area here and or this area here. Thus far, this still looks like a counter trend move within the context of an existing downtrend. Not making any assumptions, we'll see how it unfolds. Now we're looking at Nvidia in isolation. This is the end of 2023 here. The dark lines are anchored volume weighted average price lines. So far, the pullback that we have in recent weeks held right at this line here tied to the end of 2023, right here. We pop back above the anchored volume weighted average price line, tied to this level up here before the pullback. We've got this tight cluster in the short run, so this is an important area. If Nvidia can hang above these lines, it's more likely to resume its rally in this direction. If it pops down in here, maybe more likely to consolidate. And if it starts to take out these lines here, maybe more likely to drop and make a lower low below this line and this intraday low here. Right now, it looks like a chart that's trying to reestablish the uptrend after this counter trend move. We'll see how it unfolds. Very similar concepts here. SMH in isolation. This time we're looking at a 65-minute chart. The thick dotted lines are moving averages. The very thin dotted lines that may be difficult to see are anchored volume weighted average price lines. And you can see we came down on that chart, undercut the lower one here in orange, tied to the end of 2023, and thus far we've held. If we go to the straight daily, you can see the line again tied to the end of 2023. Here we undercut it, and thus far we've held above it. And from a longer term perspective, notice the slopes of all the longer term anchored volume weighted average price lines. They all remain up with price above. So chart of SPY daily, S&P 500 ETF that we've covered in past videos. This is the look back here. The correction in 2023. Dark solid lines are moving averages. The thin lines that are probably difficult to see are anchored volume weighted average price lines. This is the end of the correction here early in November of last year. You can see we're trying to take on that type of look. The longer above, the more meaningful it becomes. This continues with that so far so good theme that we've talked about in the last 2 weeks. Possible you can make an argument that this still looks similar enough to this area in here. However, slope of this line looks a little bit better. Green looks like it's trying to turn back up. We're back above all of the anchored volume weighted average price lines and both of the moving averages. We'll learn something if price moves back into this area here, which is similar to what happened in here. Similar concepts. You can see the low here in October of 2023 occurred near a logical level, the weekly anchored volume weighted average price line tied to the major low in October of 2022. This is SPY weekly. This correction last year, the blue line. The bottom is the red line. They intersect right here. These are the weekly lines tied to the end of 2023 and the low early on the weekly chart in 2024. You can see we came back, quick overshoot, and so far we've held in a bullish manner. Sloping upward, sloping upward, sloping upward, both of them sloping upward and price above. This too falls into the so far so good category. The daily chart of the NASDAQ composite. These are Bollinger Bands up here around price, and this is standard RSI, or the relative strength index. Notice RSI's character changed here in August, and then the market corrected. You can see RSI had trouble getting out of the red box during the correction. That changed at the end of the correction here. We just did something here that we never really did in here. Popped back down and held and popped right back above. We briefly did it in this region here. So we still need to see a little bit more, and it is possible that this look over here looks similar to this look here. Like all of these charts, reference points, we'll learn something if this starts to look more like this again, or if this over here starts to look more like this. It's also relevant that the weekly chart that we covered earlier thus far is making a stand above an upward sloping 30-week, 40-week, and 50-week in green. So let's revisit the fear of inflation debate relative to subsiding fears relative to inflation, interest rates, Fed policy, and valuations. It's the Dow Jones Corporate Bond Index, very similar to the ETF LQD. To make an argument that the present day look here, trying to make a stand, the 200-day moving average, where my cursor is upper right-hand corner of the screen, is similar to this stand here. You can see the concerns about this topic have lingered in this case quite a bit longer than they did in here. But so far, the Dow Jones Corporate Bond Index broke above the 200-day moving average and looks like it's coming back and retesting it. The longer above, the more relevant it becomes, and also the longer above this base here, the more relevant it becomes. We'll also learn something if price moves into this area here, similar to this look here in 2022 when the bear market in stocks began. We can also look at this chart of the S&P 500 down here and ask and answer. Do we really think the S&P 500 would break out above this high after basing for quite some time, pull back, hold above the high, and then start to push higher if we were in this situation where the market was highly concerned about inflation? This region here, when the market was highly concerned about inflation, this ratio doesn't seem to be highly concerned about inflation. The fact that this bullish breakout down here in the lower right-hand corner of the screen is holding, that doesn't seem to be highly concerned about inflation. And right now, it's fair to say that we're holding above this base and we're above the 200-day. It does look better than early 2022 in here. Still have work to do, and this is still an indecisive look. To close things out, late in the session on Friday, May 10th, it's pretty easy to see that the longer-term trend remains unquestionably bullish. Having said that, the message from the charts that we opened the video with, the Dow Jones Industrial Average, the Dow Jones Composite Average, the NYSE Composite, the S&P 400 Midcap Index, and RSP, the equal weight S&P 500 ETF, these breakout and somewhat indecisive looks pass the common sense test. The Fed and the markets are not particularly sure about what the next moves are relative to interest rates, what the next reports are going to look like relative to inflation, and what that may say about current valuations. But as we noted, this indecisive behavior up here is occurring under bullish conditions, and even if these topics tend to disappoint in the short run, these markets could still pull back significantly while maintaining a longer-term bullish posture, which reminds us that longer-term investment objectives require longer-term thinking. Even if things don't go particularly well in the coming days and weeks, the primary trend unquestionably remains up. And we all know, if we're going to continue to interpret things effectively, it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.